economists revising their GDP forecast following a batch of weak economic data this week. So is this just a slowdown, or are we facing another U.S. and global recession? Joining us now is Drew Mattis, senior economist at UBS Investment Research, and Bricklin Dwyer, North American economist at BNP Paribas. And you recognize that other guy, that's Ron Insana. He's with us here as well. Drew, let me start with you. You say we are seeing a slowing, not a recession. You think nothing, including the Philly Fed Index, points you towards recession. Why is that?
Well, I think if you look at the Philly Fed Index, what you have to realize is that there's a sentiment component to it. And the way you know there's a sentiment component to it is if you're trying to forecast it, one of the things you include in your forecasting is the VIX. So the higher the VIX, the lower the Philly Fed. And what it tells you is that you had a downturn in economic activity, you had a slowing in economic activity. You didn't have it drop off the cliff, though, the way the Philly Fed suggests. And the way you know that is because if there was a drop-off in economic activity of that magnitude, claims would have risen substantially, and weekly retail sales data would be soft.
Bricklin, you take the other side of that. You say the chance of another recession is greater than 50%. How come?
Yeah, well, we see in fact, going into this week, we thought that things looked pretty bad, and we put the odds right at 50-50 for a recession in the United States. And after the recent slew of data which pointed to greater weakness, we put the odds at greater than 50% at this point. And largely due to, just the shock of the magnitude in not just the Philly Fed. While it is certainly a sentiment index, it does reflect, the hiring intentions for small businesses and what they want to do, and generally across the board in the manufacturing industry and their outlook of the U.S. economy. So we saw this both in current expectations and future expectations for that measure. But we also saw a huge decline in consumer confidence Friday last week.
Ron, I mean this mostly rhetorically, but does it really...
So you don't want me to answer?
So does it really matter whether we're in recession or not if, using the quacks like a duck, walks like a duck, looks like a duck scenario, it feels like we're in a recession, and what we seem to be dealing with most especially is a question of confidence, business confidence, consumer confidence.
But I don't think we're in a recession yet. I mean, we may very well get there if these problems persist, and I think Europe and what's going on in China are real issues. And I think the risk of a policy mistake, Tyler, is the thing that would blow my optimism up completely. I mean, I've been in the camp that there's no place like home all this year, that we were going to grow fine. And we're seeing policy mistakes all around the world. China's really tightening from a monetary perspective along with India. Europe is in complete and utter disarray. And the U.S. risks tightening on the budget front that could tip us over into a recession if they cut short-term discretionary spending rather than dealing with the long-term unfunded liabilities of the government. So I worry about those things. I think we skirt the recession, but I still think that the risk has gone up in recent weeks.
Drew, I mean, you say that a lot of what you think that's out there that's negative is just sentiment, but can't sentiment, become sort of a self-fulfilling prophecy?
Sentiment can be a self-fulfilling prophecy, and there certainly is increased downside risk. But saying that there's a high probability of a recession, saying we're going to skirt the recession, then, I think that there's a lot of talk out there about having a recession. But when push comes to shove, when we look at our forecast and we compare it to the consensus, most of the consensus is right around where we are, which is slightly accelerating growth in the second half of the year. That's where Bill Dudley is. That's where Cleveland Fed President Pianalto is. And that's where most Wall Street economists are, even the ones who are talking about a recession.
What kind of number, like 1%, 2%? What do you see in the fourth quarter?
Well, fourth quarter, we're looking at 2%. Second half of the year, we're looking for around 2%. And that compares pretty favorably to first half of the year being under 1%.
Bricklin, multinational corporations, U.S. corporations have certainly not been in a recession. But I think if you look at any of the polling data, a lot of Americans don't feel like we ever really came out of the recession. My 401k is really not back to where it was. Yeah. My house is nowhere near worth what it was. I don't feel like I ever really emerged from it, which is really sort of what I was driving at with Ron there. Does it matter what the numbers say when the sentiment says something so distinct?
Well, I think that's quite important. What we haven't seen is any kind of, monetary tightening in terms of like we really came out of a recession, which means that, we haven't really come out of it very far. So, looking at the markets now and talking of consumer confidence, we look at the equity market and we see destruction of wealth, and the same thing in the housing prices. As you've said, we expect a continuation of housing prices to decline for the rest of this year. Mm-hmm. So if you have housing prices declining and equity prices declining, your wealth is declining and deteriorating. trading, and you're not going to be spending.
Right.
And that's a real headwind for this economy.
Thank you very much.
Consumers spent in July when confidence went down. I mean, so, you have to really watch what people do and not what people say. It's very easy to look at the equity market and get upset.
Yeah. That's a great point.
And it's something I've talked about not too long ago, which is the fact that you walk around the streets of many major U.S. cities, and there's a lot of action out there, surprisingly enough.
We're going to leave it there, guys. Thanks so much for joining us.